Hey there guys, how's it going? Welcome to the FTSE show, me, Chris Chillingworth. Hope you enjoyed the last episode. Today I want to try and keep this under 15 minutes long. I want to keep this nice and short. And so we're going to dive straight in, we're going to get going, and we're going to start really churning through these companies, hopefully, episode by episode. Last week we looked at Associated British Foods, or the last episode I should say, I don't know when these are going to come out, but we looked at 39 points, so they scored the highest that we've seen so far, but not good enough for what we're looking for. We're looking for that magic sort of plus 100 number, so none of these companies that we looked at so far have been anywhere near the grade of what we're looking for. Today we're going to take a look at a company called Intertek Group, so let's get started and let's dive into the numbers. Okay, so today we're going to look at FTSE 100 company Intertek Group PLC. These guys are a quality assurance, product testing sort of business. I don't know a lot about them in all fairness, but I don't really need to know too much about them in terms of identifying whether or not they're a good investment, because most of my investment decisions are based on the performance of the business. So it does matter. I'd say maybe 5% of my decision making is based on what they actually do. And that comes right at the very end of my process. I'm only going to really sort of juggle between companies that have all met the grade. So few companies meet my criteria. So few FTSE companies meet my criteria that I'm not exactly spoilt for choice in companies that pass. And I will then, once I've got my small watch list of stocks that have met the grade, I'll then go through those and identify which are the right sort of businesses that I want to be an investor in. So let's dive into these particular numbers then. So first of all, something that I always do is we look at the revenue of the business first. Is it going up? Is there signs of growth? We absolutely have seen signs of growth. We go back to 2008 when the company were making about 1 billion a year. Now in 2018, we do not have 2019's data, by the way, at the moment. That's not due out until their accounting year ends on the 31st of December. So we've still got a few weeks left yet until that comes out. And then probably won't actually see it being published until maybe January, February, but we'll wait and see. So we can only go up to 2018 at the moment. But as of 2018, we've gone from 1 billion to 2.8 billion in terms of revenue of this business. And every single year, we've pretty much seen that increase that we are looking for. Certainly over the last 5 years, we've seen a growth from 2 billion a year to 2.8 billion. So it's pretty good. There is definitely growth in revenue. The company are able to get out there and find more business and bring it in. So that's awesome. I want to look at the company's gross margin. If you remember when we looked at ABF in the last episode, these guys were running at about 5-6%, I think it was. It might have been 7 or 8% actually in terms of the gross margin, i.e. the slice of the pie. What slice is the company getting to keep? So when the revenue comes into the business and all the cost of sales, the cost of the expenses of running the business are taken out, what slice is left for the business before deductions for research and development, before interest on debt, depreciation, taxes, what slice is there? Intertek Group look way better than Associated British Foods do in this area. Their gross margin sits at around 13, 14, maybe 15%. Obviously it goes up and down different years, but we're looking at, I'd say, probably an average of about 14 to 15% here. Way better than Associated British Foods. It's a much bigger margin. It's still not great, but it's way better than Associated British Foods. It's a much more comfortable margin to have. One thing I noticed, however, in 2015 is we've actually got what looks like a losing year. That year they brought in a revenue of 2.1 billion, but the cost of sales alone, the cost of doing their business, came to 2.4 billion. So they were already nearly 300 million down from the very beginning in 2015. We haven't made all the deductions yet, so that's certainly going to be, I suspect, a losing year for the business. That's a bad sign, unfortunately. Losing years can really hinder a score in this process that I use. When we're looking for growth stocks, with stocks that are going to go up in value, losing years are always worrying because they can certainly knock a share price down. But we'll see what happens here. So we've got no issues around the expenses, the company expenses and the running of the business there. in terms of the amount of those expenses. We've got no real issues over R&D or depreciation. Those costs are well within what we'd expect. We could look at interest on debt. What kind of financing costs are there for this business? That is a little bit higher, I think, than what we saw with Associated British Foods. We're looking at about 7 to 8% of the operating profit. So again, we're not talking about bad figures here. These are well within the limits of what we would expect to see. Not a problem at all. In terms of the overall trend of those costs, I would say they look pretty flat to me. They don't seem to be going up in value. It doesn't look like they're taking on more and more debt, or the interest on that debt is rising for any reason. So that's fine. That's all good. That's not a problem at all. We can go down. We can bypass tax because the company can't do much about tax. We can look at net earnings now then. So what is the slice of the pie that's left after all deductions? And that looks pretty healthy. It's not too bad. The company is sitting on about 10% to maybe 11% a year net earnings. That's just, it's okay. That's very average. Nothing exciting, but it's strong, it's stable. Obviously, we've got this losing year in 2015 that it was a minus 16% net earnings year. So they made a loss of £350 million that year. I'm not entirely sure why that happened. Looking at the numbers, it just looks like the cost of sales spiked for some reason that year. And the cost of doing business for Intertek Group got very expensive and wiped out all the profit that year. But then by the next year, by 2016, 2017, 2018, things seem to return back to normal. So not quite sure what was going on there, but it's cost them, and that may have hindered the share price growth somewhat. We'll have a look at the charts towards the end. But otherwise, other than that losing year, things have looked pretty healthy. Far better than Associated British Foods. At the moment, looking at this basic data right now, I would say that they're probably going to score higher than Associated British Foods have. So we may well find that Intertek Group take top spot at the end of the show. We will see, of course. But yeah, 10% is pretty good. 10%, 11% is a pretty strong net earnings. It's a pretty good slice of the pie to be left with. Any company making 10, 11% profit every year is doing all right, So we look at assets against liabilities. So we're looking at current ratio, current assets against current liabilities, assets that are going to be liquefied into cash quickly. So we're talking about inventory. We're talking about cash in the company bank. That can be turned into cash like that. Inventory, you can sell inventory really quickly, usually, so that can be turned into cash nice and quickly. We've got net receivables. Net receivables are invoices that the company have sent out that are yet to be paid. So just chase them down and maybe you get some of that money in. That's easy to turn into to cash. So what we're looking for is we're looking for assets outweighing liabilities. We look at the current ratio as a quick way of doing that. Looking at how much do assets outweigh liabilities. And we're looking for a score, that's pretty healthy. With this company, Intertek Group PLC, this is ITRK, by the way, is the EPIC code. I should have said that at the beginning. These guys have got a current ratio of 1.3. Over the last 5 years, it's pretty much been stagnant at about 1.4 to 1.3. So it's stayed flat, it's stayed in the same area. We have seen it as high as 1.5, 1.6, even 1.7 in previous years, going back for the last 12 years. But certainly over the last 5 years, we're looking at a current ratio of about 1.3, 1.4. That's okay, it's relatively healthy. It certainly doesn't look, it looks like it's going down over the last 12 years, but only just. That would be a worrying sign if we started to see 1.2s, 1.1s. That would show that there's maybe some sort of a shift going on here between assets and liabilities, more liabilities coming in than assets. But right now at 1.3, that's a healthy figure. It's not a concern at all. So we're good there. Taking a look at long-term debts then, it's another thing that I like to look at is the outstanding debt carried by the business. So the long-term debts have risen along with the size of the business. As the business has grown and it's taken on more revenue, the amount of debt that the company is carrying has grown. The way I like to measure the debt, therefore, because it's sometimes difficult when you see debt going up, it can sometimes be going up relative to the size of the business growing, in which case it's fine. So the way I like to measure it is to look at what is the debt level in comparison to the earning power of the business. And that's a good way of working out, are the company biting off more than they can chew? And this company are not. This company have their debts under control, I would say. The level of debt, the level of borrowing that they're currently borrowing is 846 million. That would take them about 2.8 years to pay off based on their current earning potential, their current net earning potential. And so that's fine. That is starting to get close to the limits of what I would like, but it's not there yet. It's still within the safe zone, but it's not quite there yet. So good, things are all right there. You know, they're not borrowing above their station, if you will. The next thing we can look at is the retained earnings, the reserves of the business, is the pot of money that companies can pump into for many different reasons, different rainy day funds, maybe acquisitions of other businesses. The retained earnings back in 2009 were at 40 million, so quite low. Today they sit, or in the last year I should say, they sit at 607 million. So there's been a definite focus and commitment to pumping money into this pot. The 2015, the year that they lost money, however, they clearly dipped into their reserves, because their reserves fell from 547 million to 110 million in 2015. So obviously that losing year hitting them pretty hard, and they've had to dip into those reserves to keep themselves afloat, to keep them doing well. And that was a loss, or a drop of nearly 80% of the value of their reserves. However, within 3 years of that, not only have they made up the surplus or made up the difference, but they've overcome that. They've gone further. So where they were at 547 million before they took a big chunk of money out, they're now at 607 million. So they've gone higher. And that's just taken them 3 years to do. There's been a real strong focus on pumping money into those reserves. And we're looking at some quite significant increases per year. So it looks like there's been a real focus on that, which is great. And it's a good position to be in. Sitting on 607 million puts them in a strong position. Buying back their own shares, this is something the company have been doing for the last 9 years in a row, which is great. I love to see that. Bonus points for that. They will certainly get bonus points for that. So they're buying back their own shares off the market. That's reducing the amount that are currently in circulation. That's going to hopefully drive up demand for those existing shares, which can lead to share price growth. So it's a great habit to be getting into, and something that I like to see happening. Something that I'm always keen on looking into is the return on shareholder equity. What kind of return is the business getting off the assets it's purchasing, of the investments that it's making with the profits of the business? So the company make profits. The board's responsibility is to put that money into something to grow that business. They can be paying it off, to paying it into dividends, attracting new investors. They could be buying assets. They could be buying property, plant and equipment. They could be buying intangible assets like rights, trademarks, that sort of thing. But we want to see a return off that. We want to see them investing in something that's going to grow the business and bring in more money. And the return on shareholder equity score gives us an indication of that. Over the last 10, 11, 12 years, they've smashed it every single year. Every single year, they have smashed that number. Now, 2015, they didn't. It's the only year they didn't. And that was because they had a losing year. It was a very poor year for the company. All the numbers looked atrocious. Since then, it's back to green, and they're making the grade. However, there is a downward trend on the return on shareholder equity. Back in 2016, we're looking at 45.1% return. Then that's gone down to 41.2%, and last year 33.6%. So that's a concerning trend. 3 years in a row, we've seen the return on shareholder equity falling in the wrong direction. So these are scores that are well within what I'm looking for. They're in the safe zone, if you will. But there is a trend within that going in the wrong direction. So that's a slight concern, and that's going to score badly, because I'm very interested in patterns and trends. If I see a trend going in the wrong direction, that scores badly or scores against them on the algorithm. And then when we look at capital expenditure, it's just a little bit too high. They're just spending a little bit too much of above their spending power. And earnings power, I should say, on property, plant and equipment. They're just spending a bit too much, and unfortunately that goes against them a little as well. So overall the numbers look okay. Overall the numbers are very encouraging. There are some issues in here. The margins still aren't quite what I'm looking for in terms of investment. There are some concerns over that losing year in 2015. That is an issue for me. We do have overall big trends going in the wrong direction. So again, the current ratio going from 1.6 down to 1.3 over the period of 12 years is a long, slow decline, very gradual decline, but decline nonetheless. And then obviously we've got some concerns around the return on shareholder equity going down as well. Again, it's a decline, but it's within a safe zone, so it's not a big concern, but it's a decline nonetheless. Let's have a look at the chart then. So it's very clear to me that, and you can see this, anyone can see this, ITRK, Intertek Group, have been a great growth stock. Okay, so these guys are going to score far better than Associated British Foods or any of these companies on this leaderboard. I'm pretty sure we've got a new number one on the leaderboard today. Clearly what we see here is that when companies are even getting close to making the grade of what I'm looking for, this is correlated with good share price growth. Okay, so not a company I would invest in. Why? Because there are better opportunities out there. There are companies performing even better than this out there. I'm looking for scores of 100. I don't think these guys are going to make 100. They might be close. We'll see. So over the last 10 years then for Intertek Group, the share price has risen from £7.98 a share to £57.66 a share. That is a 622% growth over the last 10 years. If you were to annualise that, chop that up into 10, you're looking at 62% a year growth, which I don't care who you are. If you've got a stock in your portfolio that's achieved you 62% return a year, you're never letting go. It's a fantastic result. Obviously, it doesn't work out that way. It doesn't go up 62% every single year. That increase is going to happen at different periods of time over those 10 years. Over the last 5 years, it's been an 88.9% growth stock. And over 2019 alone so far, just coming to the end of 2019, aren't we? So in the last year, this stock has made an increase of 14.4%, which is okay. So, I mean, long term, over the last 10 years, this has been a fantastic stock to own. Intertek Group up 622%. That's fantastic. I mean, you can be they'll be one of your best performing stocks if you held this company over that period of time. Over the last year, not quite as exciting, but still solid. You know, still a solid stocks to have in your portfolio. And again, this is reflective of the fact that their financials are actually pretty good. They may not make the grade for what I'm looking for, but they're actually pretty good. They are pretty good in comparison to many of the FTSE stocks that we will see on this show. So yeah, Intertek Group, very solid business. So I think it's time to look at the leaderboard and see how they fare against the others. So just looking up the score here to see how they performed. Okay, very nice. Intertek, FTSE 100 company, ITRK, the EPIC code, scored a rather exciting 84 points. So they didn't quite make it to the 100, but they are easily our top company on the leaderboard. So let's put them in place. So we see AA fall, Royal Mail Group are falling. These companies are not going to be anywhere near the top by the time we've gone through more of these companies. Their numbers were just nowhere near good enough for what we were looking for. I may need to invest in a better solution for this leaderboard. But there we go. Intertek Group, number one, 84 points. Easily the best company that I've analysed so far on the FTSE show. If I was going to invest in any of these companies, it would be Intertek. However, for me, they're still just not quite good enough. There's still some concerns there, still some poor trends going in the wrong direction, stuff like that puts me off personally. And I know there are companies out there which do not have those negative trends, that everything's moving in the right direction, where every single box is ticked, that they don't have these losing years. That 2015 losing year definitely cost Intertek in terms of point scoring. they're very, very close to being a company I would invest in, but just not quite there. So yeah, thank you for watching. I hope you've enjoyed this episode. If you have, please leave comments underneath. Please like the video if you enjoyed it. What that does is if you like this video, give it that little thumbs up on the actual video. It just means more people out there get to see it and their suggested videos and stuff like that. So it just gets bigger reach. And that would be cool. If you can help me out that way, that would be awesome. Thank you very much for watching. I hope you're getting some enjoyment from these videos. I will continue to do more all the time. People are enjoying them. And yeah, thank you for watching. I'll see you soon. Cheers, guys.